So the next thing we're going to talk about is the single step income statement, and we will come back to the difference between the perpetual and the periodic at the end. The difference between those two systems will come back in the end. There is something called a single step income statement where all the revenues are recorded in one place and all the expenses are recorded in one place, and this is subtracted. The expenses are subtracted from the revenue, and it's simple. There is no calculation of gross profit. So all the sales and other revenues are added, and then all expenses, including cost of goods sold, are added. There is no calculation of gross profit. This is called a single step income statement. The multiple step income statement is what you have been looking at so far. Is it calculates gross profits, and then it calculates income from operation, and then it calculates the income. And this is what you have been doing. Net sales minus cost of goods sold equals gross profits, and then you have all the expenses that are related to your operations, and then you have operating expenses. Now, there is one more twist to this story, that is, once you subtract the operating expenses from the gross profit, the line you get is called income from operations, because you could have income from outside operations that are shown separately, and you could have expenses that are outside the operations shown separately. For example, here we have other revenues and gains. For example, let's say you are in the business of selling milk, like Baladna, and Baladna had a land that it purchased and it kept, and now it's selling the land for a gain. So it purchased the land for $1 million, now it's selling it for $2 million. Well, this $1 million profit from selling the land is not from operations, from selling. This is going to be shown in other revenues and gains. You follow? Let's say Baladna owns stocks of another company and they pay Baladna dividends. This is not going to be income from operations. This is going to be income from other than operations. So there is a separate line that shows other revenues. You follow? You could have expenses that are not related to operations similarly, right? So in this case, you have to show the expenses as outside the operations. So it is possible that the company maintains a guest house for people who come from outside, and they have to pay for the expenses for that guest house. This would be other expenses. This does not have anything to do with producing. You follow? Other expenses. After the other income and other expenses are added and subtracted, there is a new line which is called income before income taxes. So you have the income that is before the income taxes are paid, and then you have a separate line that shows income tax expense. And then the net income is calculated after that. You follow? So this is the format of a multiple step income statement in its simplest format. Any questions? Anything you have difficulty understanding here, right? Income from operations, yes. Other income is added and other expenses are subtracted from income from operations, and that line is called income before income tax. Income before income tax, and then tax, because you need this line to calculate the tax. this income before income tax line is used to calculate tax. You follow? Taxable income. Very good. Taxable income is right here. And again, in simple terms, this is the taxable income. But taxable income calculation is another whole different set of calculations. In real life, calculating taxable income requires you to know what can be included in taxes and what cannot be, what can be included in expenses and what cannot be included in expenses before calculating taxes. All right? I'll give you just a simple example. For example, let's say I have a company and I use the company money to entertain guests that come to visit my company, come to visit my office and so forth, right? So I take my clients to lunch or I take my visitors to dinner, etc., etc. I'm talking about US income tax. Only 50% of that can be deducted from expenses as expenses calculate income tax. The other 50% you cannot subtract when you're calculating income for taxes. All right. Again, if you don't understand, don't worry, but I'm just trying to tell you that income before income tax is a complicated matter, right? And tax laws vary from country to country. And in the same country, for example, in the US, there are 200,000 tax codes. And I worked in taxes for my clients for 8 years, and I only know a handful because I only know those tax codes that are applicable to my clients for their business. For example, I don't know what the tax codes are for oil and gas business, right? I don't know the tax codes for coal mining, for example. I don't know what is accepted and what is not. I know small business restaurant only, which itself is tremendous amount of information. Okay? All right. So now, the way the cost of goods sold is determined in the multiple step income statement for periodic system, the perpetual, we record the cost of goods sold every time you sell. We looked at that system. But now what we do is, at the end, we don't record any cost of goods sold. We calculate cost of goods sold at the end. And the way we do that is by counting physical inventory. So you have to take physical inventory, right? You have to take physical inventory. And it can be complicated to take physical inventory for a supermarket as well. And they usually do that once a year. I worked 8 days, 8 nights, okay, for a petrol station, 8 nights, and I couldn't do that anymore. It was just too much for me. But 8 nights, night shifts, from 10 o'clock at night until 6 o'clock in the morning. You know, the Wukud petrol station, they have a shop. What is the name of the shop? Sidra. So I used the petrol pump I worked for is Chevron, right? It's in Alabama. They have a shop like this. And when you go and you have gone, all of you have gone into Sidra. Many, many different types of chocolates, many, many different types of juice, many, many different types of this and that, right? Well, they used to do physical inventory once a week, right? So you have to count, let's say, the boxes of chewing gum that are whole. One box has 20 packets of chewing gum. You count the whole boxes, and the box that is open, you have to count that there are 9, right? And there is a whole sheet, a thick sheet of paper, you write in every one. 10 whole boxes, 9 loose. You go through the entire shop and you write, this is physical inventory count, right? And then you calculate the cost of each one of those items. You understand the complication of this? This is usually done For big businesses like Lulu and so forth, usually once a year. Once a year. You follow, right? The other times they go on estimates, right? Estimations, right? Right. Every year, that's physical inventory count. You follow? You count once a year, right? Very good. Not if something is missed, something is missed, right? So understand the financial reporting is reasonably representing the reality. It is not entirely accurate. Okay? So now you get into this math, which is approximately correct. Okay? Approximately correct. So the way this is done is you have the purchases, you have the beginning inventory first, right? The beginning inventory is the ending inventory from the last period, right? So January 1st, the inventory is equal to December 31st of last year, right? You close shop at 5 o'clock, let's say, or 2 o'clock, let's say, and you take the inventory, that's the ending inventory for December. You open shop January 1st, that is the beginning inventory of January, right? Are you following? Then you add all the purchases that you made throughout the year and you subtract the purchase allowances and purchase discounts, right? You know what these are. Purchase allowances and purchase discounts. Allowances are given back. The customers are given a reduction in price because there is a defect, or you could give them a discount because they're paying on time or they're paying early. So then you have the net purchases minus the discounts, and you will add to this the freight in. Okay? The freight in. Are you following? Then you have the total cost of goods purchased. So everything that you have plus everything that you purchased makes your cost of goods available for sale. So everything I had plus everything I purchased equals to what I have available for sale, right? Then at the end of the year, you take a physical inventory, which is 40,000, and you subtract that from the cost of goods available for sale, and it gives you cost of goods sold. You calculate that one time instead of doing that every time for which inventory system? Cost of goods sold is calculated every time for which inventory system? Perpetual. Remember the word period. The word period is associated with the period end inventory counting. Inventory is counted in the periodic inventory system at the end of the period, right? Perpetual means continuous. The word perpetual is similar to continuous. It is continuously counted, right? So cost of goods sold is calculated continuously. Okay, so here we have the cost of goods calculation. Now, in the next slide, there is an exercise. Please do that, looking at the solution when you go back, and then look at the solution. It's and yes. For this one, where did the 356,000 come from? I know that it's inventory. Which one? The cost of goods available for sale. The cost of goods available for sale is this number plus this number. What you had plus what you purchased is equals to what you have available. So this is all the purchases, right? Plus the beginning inventory equals to cost of goods available for sale. All the purchases, you're subtracting them from the inventory. No, I'm adding. This is, I am buying, right? And then at the end, I have the inventory left. This is what shows what I have sold. So everything, the cost of goods purchased,
half, which is the inventory in January 1, plus all of the purchases.
Yes. Right?
And the net purchases in addition to
the cost of goods purchase, yes. So the cost of goods purchase shows all the costs associated with the purchases, right? Minus equals to the cost of goods available for sale when I add that with the beginning inventory, right? And then subtract the ending inventory and I get cost of goods sold. Clear? Okay, good question. Any other questions? Okay, so what we have now is this exercise, and I am going to do this exercise now or next week. I have posted the exercises for chapter 5, but they are not going to become available to you until after the exam. Okay, so don't worry about them now. I did not give it to you on purpose. Just focus on the first 4 chapters, okay? They are in Blackboard, but not available to you. You cannot see them, okay? You will see them 9 o'clock next Tuesday. 169 hours and 10 minutes from now, inshallah. Okay. Now, we have something called the gross profit rate, which is a very, very important concept. What is gross profit? Sales minus cost of goods sold. What is gross profit? Sales minus? How many times did you write this? Many times, right? At least 5 or 6 times you calculated sales minus cost of goods sold. The line that you put the number in is called gross profit. You want to know what is the gross profit percentage. You want to know what percentage is the gross profit of your sales, right? Because the higher the gross profit is, the more money you have to pay for operations, and the more money you will have left over as net income, right? Now, it shows you, the gross profit shows you what is the percentage of profit after the cost of the inventory. So the cost of goods sold is the cost of inventory, right? The way it's calculated is as follows. You have on top the cost of goods sold, and you have in the bottom the sales, right? I'm sorry, not cost of goods sold, gross profit. You have on top gross profit, and you have in the bottom net sales, and it gives you a percentage. That means 43.9 means when I sell 100 riyals worth of items, I am making 43.9 riyals in gross profit. That means I paid for the inventory 56.1, the difference, whatever the other side is, that is what I paid for the inventory. Now here you see the two numbers are compared, 2010 and 2009. In 2010, my gross profit is 43.9. In 2009, my gross profit is 44.7. Which is better? Which gross profit percentage is better? 2009 and 2010. What could be the reason for a higher gross profit? Or what could be the reason for a lower gross profit? Because if I am this company, I don't like my gross profit to have reduced 0.8%, right? It went down 0.8% from the previous year. Anyone wants to take a guess what could be one possible reason why the gross profit is less? Meaning? Say that again. This is not showing the amount. It is just showing percentage. So what Ms. Sausan is getting at is If you sell the item for the same price, but you purchased it for more, right? Your profit is going to be less. So I'm selling this one bottle of water for 1 rial, right? And I pay 25 dirham for it, right? My profit is going to be higher than if I purchased it for 50 dirhams, right? So that is one possibility, that I paid for the items more this year than last year. It is also possible that I paid for them the same amount, but I had to reduce my sales price. Are you following? Like many companies are having to do to get business, like airline companies, they're all competing. I got an email yesterday, somebody trying to selling me a ticket for $19. You follow, right? Somebody trying to sell me a ticket for I don't know where I will go, from maybe Doha to Al-Khor, I don't know. But airlines trying to selling me a ticket. I did not open the email, but it says fly for as low as $19. You follow, right? Back in the day, right, 20 years ago, I did fly. I mean, I had purchased ticket for $50, but this was 20 years ago. That's a different story. Sales price could be going down, inventory price could be going up. Either one of these could reduce your gross profit. Are you following? Right? Sales discounts, if they increase, if you have a lot of sales discounts and you have a lot of sales returns, right, with damaged goods, then it also will reduce your gross profit. Are you following? Okay, so this number is very important. When you look at the financial statements for 2 different years side by side, and you look at the gross profit percentage varying, go back to the previous line to see what happens to sales, what happened to cost of goods sold, what happened to sales allowance, what happened to sales discount, to find why do I have a lower number? Why do I have a higher number? Are you following? Okay. The second thing that we want to look at is the profit margin ratio, which is calculating the net income divided by net sales. So instead of cost of goods sold, now we go to the bottom line. So here now again we have the net income on top, and we have the net sales. Before we had gross profit on top and net sales in the bottom. So now net income is the bottom line. You know, you have heard the expression bottom line, right? Have heard the expression bottom line, right? Bottom line, the bottom line, people say the bottom line is, right? The bottom line is the net income. So we have 2% and we have 1.8%. What could be the reason for profit margin ratio to go down? Many. Because all operating expenses are included in calculating the net income. All gross profits are calculated in added determining the net income. So you have to go back to the lines to see where is the problem. Why do I have a particular expense higher? Why do I have a particular expense lower? Why do I have a particular income item higher and lower, and so forth? And we're going to do, this is just getting our first introduction. We'll do this when we look at financial statements of different companies to see what is the reason for higher profit, lower profit, higher income, lower income, and so forth, right? Lower percentage is better. I had a 2% profit versus 1.8% profit, which is better. 2 is better, right? Remember, if I have higher net income, right, that is better, which will make my number higher, right? Just think about it this way. If I have 1,000 in sales and I have 100 in income, that's 10% profit. If I have 1,000 in sales and I have 200 in income, that's 20%. Which is better? 20%, right? The higher the net income, the higher the profit margin will be, right? Profit margin, higher gross profit margin are all better. Sometimes this, when you're looking at a financial statement critically and trying to see if the financial statement is accurate or not. For example, I know when a financial statement from a small business restaurant is brought to me in the US, I know that the gross profit is around 70%. Around 70%. Cost of goods sold is around 30%. So cost of goods sold is 30%, right? Gross profit is 70%. Somebody brings me a financial statement and it shows gross profit 90%, right? I don't have to go any further. I know there is something wrong in cost of goods sold and inventory calculation. I know there is something wrong. It is posted to the wrong account or some miscalculation is done because it cannot be. You follow? So if you have enough knowledge about the industry, you can get an idea. So that's why you see here, the industry average is shown. You see this 5.1% industry average is shown. Now, the industry average is something that is different for different industries in different locations, even inside the same country, the regional numbers. So you become an expert in particular industry when you're doing the accounting or when you're looking at the numbers, and you know more about them. Every month when I was working for the accounting firm, aside from reading the tax updates and the accounting updates, we used to subscribe to at least 3 or 4 magazines that the restaurant owners read, because we had 1,400 or so restaurants, right? When I first started, the first day I walked in, May 7th, 1999, into the office, I had 7 people reporting to me and 190 restaurants handled by them. I had no idea how to do any of that work. You follow? These people would come to me and they would ask me questions and I have no idea what they're asking. I'm supposed to be their boss. You follow? I just graduated, right? My graduation ceremony was on the 9th of May. You follow? So I go there and they're asking me this and that, and I am saying, okay, I will get back with you. I go down to my boss and I say, I have no idea what these people are asking me. I have no clue. He laughed and he said, you know, we'll teach you accounting, don't worry. You follow? So when I went there, I actually did not know much about how it's done in the real world, right? That's why I like to bring the real world so much into the class, is because people don't do it enough. And a lot of times people cannot do it because many people have not worked in the industry, right? So we used to read, right, these magazines, what burger is hot, which restaurant is top, what is the cost of chicken, what is the cost of bread. So we would have an idea. When we look at the financial statements, we would have an idea that here the cost of cheese and cost of chicken is more because of less production. Whatever it is, I'm just giving you some examples. So we would know when the financial statements come to us, that information will click that, okay, this is supposed to be because price of chicken went up, right? Or eggs are not available, whatever the reason is, right? So this industry average number is something that comes to you over time, and you don't know industry averages for the industries outside your industry. If you're doing oil and gas, you're expert. You're doing pharmaceuticals, expert. You're doing restaurant, you're expert. I have no clue about oil and gas, pharmaceuticals. I have no idea. But if you put me in front of a financial statements of a small business restaurant in the US, I will tell you without looking at any details, right? That this number is wrong, this number is wrong, this number is wrong, right? And 90% of the time, you'll find that this is correct. 90% of the time, you'll find that what I said wrong is wrong. This is not magic. I looked at hundreds of them, right? So when I left the company, I said, when I joined, we had 190 restaurants and 7 people that reported to me. When I left, I had 50 people reporting to me and 1,400 restaurants, right? This is just me. The entire farm is much, much larger than this. Is just me, 50 people with 5 or 6 accountants, other bookkeepers and so forth, 1,400 restaurants. So I looked at 1,400 financial statements, income statements and balance sheets every month. Every week I looked at 300 to 400 financial statements. So you can understand, right? This is just, I can look at it with one eye closed and thinking about something else, and the thing just jump out at me because I looked at so many of them. You follow what I'm saying, right? Just like when you look at your child, you know the child is not speaking the truth because it has happened to you so many times. You follow, right? You don't have to check. You know this is not the truth. Okay, so this is how it becomes. All right. So here, what we have here is another ratio, which is the last one today, the quality of earnings ratio. What is the quality of earnings ratio? The net income includes both income coming from operations as well as non-operating activities. You want to know how much cash you're getting from your operating activities. That is a measure of the true earnings. The true earnings. What does this mean? Just bear with me. Let me explain this to you. When I say net income of 1 million, and I have 500,000 of that as accounts receivable, right? Because I record sales when I have accounts receivable, don't I? I record sales when I have accounts receivable, don't I? I credit sales and I debit accounts receivable. There is no cash, right? So when I have 1 million in income and I only have 500,000 cash coming to me, right? It is not the same as if I sell 1 million and 900,000 coming to me as cash. You follow? When I have 900,000 coming to me as cash, my quality of my income is very high because I cannot pay anyone with accounts receivable. If I have to pay somebody, right? Let's say you work for me. At the end of the month, I cannot pay your salary with accounts receivable. You will not take accounts receivable from me. If I say, look, I have accounts receivable, go collect it from the customer. Very good job. Just collect your payment from the customer. Will you do that? Will you be found the next day? You will leave. You follow? So you will take cash. The supplier will take cash. Everybody will take cash from me. You follow? So if I have a lot of non-cash transactions, then it's not good. So I want to look at the net cash provided by operations. How much cash did I get? Right? What is that as a percentage of my net income? The more cash I'm able to get, the higher the quality of my income. Are you following? This is the basic concept here. Okay? Is that clear? Okay. Now, just quickly, over the next 10 minutes, I'm going to do a comparison between the two methods, the perpetual and the periodic, and show you side by side those two items, and then we'll go to your questions, right? So here we have the merchandising transactions. Like, let's just jump into the transactions. We have discussed what is on this slide before. We have here in the periodic inventory system, the one we did was perpetual inventory. In the periodic inventory, this entry is exactly the same. We have purchases and we have accounts payable. This is what we did before. When we buy, we debit purchases and we debit accounts payable instead of inventory, right? Instead of recording debit to inventory, we debit purchases. When we did the perpetual inventory, we debited inventory and we credited accounts payable. We just did it an hour ago, you remember, right? You don't remember, it's in the video. Okay? let me just go to this slide right here. You see this. This is the this is not showing the purchasing side. This is showing the sales side only. Oh, here it is, here it is, here it is, here it is. You see this? This is what we recorded. You see in the perpetual inventory, we debited inventory and we credited accounts payable. This we recorded when you buy inventory. In the periodic, you debit inventory and you credit. I'm sorry, saying it wrong. Debit is to purchase and credit to accounts receivable. This is the comparison between the perpetual inventory and periodic. The perpetual we did line by line, if you remember, we purchased 3,800, we debited inventory and we credited accounts payable. In the periodic system, what we do is we debit purchases and we credit accounts payable. In the perpetual, we paid for the freight. When we paid for the shipping, we debited inventory for 150 and we credited cash. Remember this entry? In the case of periodic, we do freight in and cash. See the difference? We do freight in. This freight in will be added to total purchase later. Okay? In the case of accounts payable, in the case of purchase return, we debit accounts payable and credit inventory. In the periodic system, we debit accounts payable when we credit purchase returns. So instead of inventory, we record it in purchase returns. When we get a discount in the perpetual inventory, we debit accounts payable and we credit cash and inventory. You remember we made this entry, right? In the periodic inventory, instead of inventory, we record that to purchase discounts. Okay, we record that to purchase discounts. This is the difference between the two. And
purchase inventory. Why one system is called inventory and another system is called purchase?
Because in the perpetual inventory, the inventory account is maintained continuously. So you change the inventory account every time you make a purchase or a sale. In the periodic inventory, you don't change the inventory every time you purchase or sale, make a sale. You change the inventory at the end of the month or end of the period, the way we looked at in our calculation. You follow? So the inventory account is not touched until the end of the period. The purchases is a separate account, which is a temporary account that is maintained throughout the year for purchases of inventory. It's the same, the actual event is the same, right? But the calculation is different. So if we go back here, what you have been doing so far in all of your exercises is this: inventory and accounts payable, right? This is what you have been doing in all the exercises that you have done. You have been doing this. But the second type of inventory system is the periodic inventory system, where the inventory account is not changed until the end of the period. So you put everything that you buy in purchases, right? And then you, at the end, you add the purchases to, who can tell me? What type of inventory? Beginning. You add that beginning inventory. So let me go back to that slide, and it will bring this concept home, inshallah. Let me show it to you again. It will come back. It will take a little bit. You will understand. It's nothing, not rocket science at all. So you have here, you see, this is the inventory we have, right? You have, this is the inventory at the beginning, right? This is the beginning of this month or this year. In perpetual, I continue to add to this inventory as I go throughout the year. But in periodic, I don't. I put everything in purchases, minus the purchase returns, minus the purchase discounts, plus the freight fee, right? Then I have the total purchases, right, which is 320,000. I add that. That 320,000 is the inventory that I purchased. In the perpetual, I would have added that 320,000 with my inventory every time I made a purchase of inventory. All right?
The 36,000 are the rest of the purchases last year.
No, this 36,000 is what I have left from last year. Right. What I have left from last year. So here, let's say I have this inventory, this is the beginning inventory, right? This is what I have. This is the beginning inventory. This is what I have. You follow? Right? I am buying inventory. I buy another. In the perpetual system, my beginning inventory was 2. When I buy 1, my inventory is 3. In perpetual, the other system. I buy 1 more, my inventory is 2. Right? But I don't do that in periodic. My inventory remains 2. I add another account, that is purchases. I purchase 1, I call it purchases. I purchase 1 more, I call it purchases. My total purchase is 2. I have 2 at the beginning. How many do I have that I can sell? This is cost of goods available for sale, right? So this is beginning inventory, this is purchased. Add it together, cost of goods. Cost of the purchase is this. Available for sale. 4 is available for sale. Beginning inventory plus purchase. Beginning inventory plus purchase. The beginning inventory is how many? The purchase is how many?
Sorry, I have a problem with that.
I will come to the problem.
So what inventory you bought to purchase? What do you call the inventory here and purchase?
Because this is what my grandfather's grandfather told me.
This is from the last year.
This is the system of this.
Yeah, I'm just telling Muhammad, like, if we apply this to the example, the first 2 are actually what you are left in December 31st, 2013. Yeah? So you add on January, March, what you
That's
have.
when you say purchases. Why? Right, this is the philosophical question.
This is continuous. This is the same on the previous system.
The reason why we do not call it inventory is because we do not track of the inventory. If you call it inventory, calculate the cost of goods sold. And you cannot calculate the cost of goods sold for items that are small. For example, how did you calculate cost of goods sold? Inventory is sold at 3 times cost. No, for example, yes. So if you sell for 3,000, the cost of goods sold is simple. Why don't you? The problem is, when you go to Google, they have hundreds of different items, and every single one of these items have different cost of goods sold. So, say a customer buying 55 items, shampoo, soap, meat, milk, batteries, cereal. Every single one of those items have a different percentage of cost of goods sold. It's not possible for you to calculate it. So everything is average purchases until the end when the any inventory is added. Alright? This is the reason why we call it purchases, why not something else? Okay, is that clear? Okay. So we come here to compare the entries here. Are you following? It will come to you once you revise this and review it. Inshallah, it will come to you once you go to the exercises. So here we have the purchases. The difference between the sales is as follows. So we have in the perpetual inventory, we debited accounts receivable, credited sales, and we debited cost of goods sold, and we credited inventory. Everybody understands these two entries, right? You have made them many times. In the periodic, there is no entry for cost of goods sold. Okay? The next entry for returning the merchandise is exactly the same. There is no entry to inventory for returned items, and the entry is exactly the same when cash is received. Cash, sales discounts, and accounts receivable. So the purchase side, the sales side is easier, where you don't have to record two entries that you record in the perpetual system. But you have to do this calculation of cost of goods sold at the end. Is it clear? Adil, under control? Okay? Okay. Now, once you study this one more time, maybe listen to the video again and do the exercises, it will come to you, inshallah. This thing is something that cannot come to you until you actually do the calculations. So you have to actually do the debits and credits, and you have to do the pluses and minuses, and I have given you exercises in the practice. It will come to you, inshallah. Okay? Now, the exam is 25%. Let me just stop recording the lecture here.